Hello, welcome back to this week's market update. Today is Monday, March 16th, 2026, and we'll jump right in. It was another turbulent week as conflict in the Middle East pushed energy prices higher and weighed on equity markets. Stocks briefly rebounded in the beginning of last week on hopes that the impact of the conflict might be contained before declining in the second half of the week and ending ultimately lower. The Dow Jones Industrial Average got hit the hardest, down almost 2%, followed by the S&P 500 down 1.6%, and the Nasdaq Composite holding up the best, down 1.26% last week. With developments in the Middle East continuing to unfold, WTI crude briefly rose above $110 per barrel last week as regional supply disruptions have persisted for over 2 weeks now. According to AAA data, gasoline prices at the pump were up about 9.3% in the past week, up 23.5% from a month ago, and then up about 18% from a year ago. So certainly starting to see the impact of the conflict at the gas pump, as I'm sure you have noticed. However, as of Monday here, Treasury Secretary Scott Bessent has reported that the U.S. is allowing Iranian oil tankers through the strait, which has led WTI crude futures lower on Monday to start the week. In other news of prices and inflation, we also had the February CPI come out last week, coming in as expected with headline inflation running steady at 2.4% and core inflation also running steady in the month at 2.5%. On a monthly basis, headline prices were up 0.3%, while core inflation was up a more modest 0.2%, overall showing some stability in these numbers here for February. Diving in a little bit deeper into some of the categories driving the pretty modest inflation print of February, you can see here food inflation has been holding steady at 2.4%, fairly healthy rate there. Dining out or food away from home has been running above average there at 3.9%. Energy prices up 0.5% from a year ago, but within that, we're seeing a lot of different movements depending on the type of energy. So things like utility gas service, that's up 10% from a year ago. Electricity also up almost 5% from a year ago. While on the other hand, gasoline was down 5.6% from last year. And this is as of February, obviously before the conflict in Iran has really taken off. Other categories here include shelter, that's moderated to just a 3% inflation rate, up only 0.2% in the month. Used vehicles have actually been dropping, down about 3.2% from a year ago, while new vehicles are up just a very small 0.5% from a year ago. Other inflationary data released last week showed PCE inflation running at 2.8% year over year on the headline number there, while core inflation was running a little bit hotter at 3.1% in January, up slightly from December's core reading. On a monthly basis, headline prices rose 0.3% in this measure, while core prices were up 0.4%. Overall, pretty moderate readings for the month. You can see that we've been slowly creeping higher in Q4 and into the first quarter of this year, but it remains within a relatively manageable range, leading the Fed to probably just hold rates higher for longer. Alongside the PCE inflation report, we also got personal income spending and savings data for January. It showed a pickup in household income reflecting Social Security cost of living adjustments, bonuses, and annual raises. Personal income rose 0.4% during the month. However, disposable personal income, which is an after-tax measure, rose a greater 0.9% during January. Personal spending was up 0.4%, allowing the personal savings rate to rise to 4.5% as take-home income growth outpaced spending. The rebound in income growth is a positive development following signs of deceleration in wage gains during the fourth quarter. Here you can see in the last several months, we had income growing at a slower pace than spending, so it is a good sign to see kind of a boost in consumers' disposable personal income. Moving along in our data, fourth quarter 2025 GDP growth was revised lower last week to just 0.7% in the quarter there. This reflected slower than expected consumer spending, lower than initially thought investment, a greater than expected drop in government spending, as well as a greater than expected drop in exports in the second revision to this GDP print. Revisions to initial GDP figures are very common. Still, it remains important to be aware of changes in economic data, especially when you get pretty sizable downward revisions. Now, despite the downward revision in fourth quarter GDP, several economic indicators have actually improved in recent months, as you can see on our dashboard here. Looking at some of these indicators, the ADS, the Business Conditions Index from the Philly Fed, is the only fully bearish indicator here. Then we have the Leading Economic Index that's been at a more neutral level. It's still not in positive territory, however, it's no longer signaling a recession. The Employment Trends Index also remains neutral. As we've seen in recent months, payroll gains have kind of ticked lower, and so as a result, that has also moved to be neutral. The other indicators here, though, ISM manufacturing, that has become much more bullish in the last 2 months. ISM services obviously has been bullish for quite some time now. The Philly Fed Manufacturing Business Outlook Survey, that's turned bullish, as well as the Chicago Fed's National Activity Index and the Anxious Index. So overall, although we are seeing some mixed data in GDP revisions and payroll growth and those sort of things, other indicators would say the opposite. So important to stay on top of all of the data as it continues to be pretty mixed. So that concludes this week's market update. It was certainly a very full week of economic data and updates. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.